On April the 6th, 2019. This Week in Economics from WBRN Radio and on the Bostonred Network. Numbers man here, our alter ego. Anyway, nonetheless, we are here and we have some very interesting news. We'll start from Fred Harker. Fred Harker is the president of the Philadelphia Fed. His position is that the strong job market, he calls it a strong job market, under 200,000 jobs in a report is not necessarily a strong job market, but if they want to put it as that, it is there. He's talking about one more interest rate hike in 2019 and one in 2020. He gave a similar assessment of the U.S. rate outlook on March the 25th. On Thursday, he said the job report, the jobless rate was likely to fall to 3.5%. I believe it's 3.8 now. And inflation would be just above the 2% target this year by the Fed. Now, this is from Reuters, and it was released on the 4th of April. There are certain aspects of the economy, I'm quoting Mr. Harker, the strength of the labor market, for instance, that point to fundamentally sound U.S. economy, he said at an event that was in Philadelphia with business economists. At the same time, he said he has eyes on the number of risks to the economy, including a weak growth abroad, a shadow spread between short and long-term bond yields. Another concern, he said, was staggering business confidence could weigh in on investments. Asked if he thought an interest rate cut would be the next move by the Fed, as many investors, Harker said he doesn't expect any rate cut this year or next year. A rate cut would signal a fundamental problem with the economy. That is, at this point, I just don't see it. One concern for long-term economic outlook, Harker said, was the decade-long trend in low interest rates. It could weigh on a bit the business dynamism. Yeah, we agree there. The administration's talked about several things. An interest cut, which is a shorthand for the economy is not doing well. And also the reinstitution of quantitative easing. These are tools that the Fed has, but the Fed doesn't normally use these unless there is a reason to keep the economy from going into further recessive activity. If you recall, during the Depression and after the Depression, not to be redundant here, the previous administration, the Obama administration, and the Fed under Dr. Janet Yellen, they instituted quantitative easing, as did central banks in Japan and various other places. Japan was a little different situation. They actually had deflation there, and they were able finally to come out of the deflationary situation. On our last broadcast, we talked about the PCIs for Japan and the Eurozone, etc., Germany. Now, there's been some improvement evidently in Germany, but that's with a note. These are report for report, And on the European sector, you have the Brexit problem. That should have ended on the 30th of March, and it did not. The present government there, Tory government, is asking for an extension. Now that extension is up to the EU. They would want the extension to go to the end of June, and that is past the EU elections. So if they are still in, they will have to participate in the EU elections. Now it could, some have suggested in the EU that they get a full year extension, and at the same time the Tory party, the Conservatives in the UK, are in talks with the Labour Party to come about with some type of agreement. So they would have something to work on. Labour would like to extend it, get a custom union out of it, and perhaps a revote on the leave. That was a very, very close election, and now many people, 6 million, have signed a petition in the UK to backtrack on it. So that is some of the views that tend to overshadow where things actually are. Now this is a little different here, and we'll do this differently also. U.S. job claims hit a 49-year low. That's a half century, almost a half century there. The loss of momentum in activity left some employers unsettled about the economic outlook. Announced job cuts by U.S.-based companies in the first quarter were the highest since 2015. Fading a stimulus. Now that was the $1.5 trillion stimulus. Now this is what is peculiar about this administration's program. Normally you don't come in with a tax cut, massive tax cut stimulus, what we used to call pump priming, unless you are in a recession. Not when you are coming out or out of a recession. That in itself does cause problems, and at the same time the tariffs and trade war with China causes problems, uncertainty here. This is from Reuters with the Brexit from the EU casting a shadow over the economy, which in July was celebrated its longest expansion on record. We are at a point of inflection where the overall economy trend is changing. That is from Joel Naroff, chief economist at Naroff Economic Advisors in Holland, Pennsylvania. That would account for at least some of the volatility and contradictory nature of the data. It also points to a slowdown, not a crash. Well, that is basically quibbling. Initial state unemployment benefits declined by 10,000, seasonally adjusted 202,000. That was the week ending on March the 30th. The lowest level since early December of 1969, the Labor Department said. Economists polled by Reuters had forecast claims to rise to 216,000 in the latest week. The Labor Department said only claims for California were estimated. And this is some data you don't really look to because it is dynamic and there's not a static count. In other words, job growth has slowed from last year, roughly 230,000 average pace. The increase, however, remains more than sufficient to keep up with growth in the working age population, holding down the unemployment rate. Well, that would depend on how much slack, and we'll get to that in a minute here. The 4-week moving average of initial claims, considered a better measurement to iron out week-to-week volatility, fell 4,000 to 230,500 last week, the lowest since October of 2018. So when you read reports from Reuters and from others, you have to read on. The 4-week average is much more accurate than 1 week. 1 week could be an outliner. It's sort of like what happened. The last monthly job creation report was at 20,000, revised to 30,000. But again, those things are sometimes outliners. You have to get more of an average going, unless the bottom completely falls out. Survey of economists and non-farm payroll is likely to increase by 180,000 jobs. They were a little low after this, and this article is a little bit off here, and 3.8 separate reports. Now this is from Challenger and Gray. Christmas, this is a global placement agency, in other words, headhunters, shows planned job cuts by U.S.-based employers dropped 21% to 60,000 in March. However, the announced layoffs for first quarter jumped 10% to 160,000 from the last 3 months. The last 3 months of 2018. Retailers continue to lead in job cuts, plummeting 46,000 jobs in Q1. The automotive sector eliminated 8,838, leading to 15,000 layoffs by auto manufacturers. Redundancies were also high in energy and the financial sector. We thought we would bring this one on, and let's get to we'll do the numbers, and then we'll come back and we'll deal with the Institute of Supply Management and their PMI. So let's go to it, and we'll finish it off as quickly as possible here. And we'll get this. This was released on a Friday. The total payroll increased by 196,000 in March. Oops. My pointer is getting away from me here. And the rate of redundancy or unemployment was at 3.8%. This is the U.S. Bureau of Labor Statistics. Notable job gains occurred in healthcare, professional, and technical services. The release presents statistics from 2 monthly surveys. Now, the household survey, labor force status, includes unemployment by demographic characteristics. The establishment survey measures non-farm employment, hours, and earning by industry. We'll put this or pinch this on. The unemployment rate remains at 3.8 in March. The number of unemployed persons was essentially unchanged at 6.2 million. Among the major work groups, unemployment rate for adult men at 3.6%, adult women at 3.3%, teenagers at 12.8%, Europeans at 3.4%, African Americans at 6.7%, Asians at 3.1%, Latinos at 4.7%. They showed little change. So in other words, not much in terms of change there. In March, the long-term unemployed, those jobless census now, this is just 27 weeks, or 6 months or more, more than that, was essentially unchanged at 1.3 million, but account for 21.1% of the unemployed. The labor force participation rate was little changed at 63%. Month over month showed little movement on the past 12 months. The labor population ratio was at 60.6% in March, and had been either 60.6% or 60.7% since October of 2018. The number of persons employed part-time for economic reasons was little changed at 4.5 million in March. Those include individuals who preferred full-time work. The marginally attached, that was 412,000. Those are discouraged workers. The remaining 944,000 persons marginally attached to the labor force in March had not searched for work. Now to the establishment survey. Non-farm payroll employment increased by 196,000 with notable gains in healthcare and professional services. Employment growth averaged 180,000 per month in Q1 of this year, 2019, compared with 223,000 per month in 2018. Somewhat of a drop there. Let's see, roughly about, we'll just call it 40,000. Healthcare added 49,000 jobs in March. Now, this was a sector that people said that the Affordable Care Act, Obamacare, would kill off. And it added over the past 12 months 398,000 over the month. Employment increased in ambulatory healthcare, 27,000. Medical centers, 14,000. Nursing and residential care facilities, 9,000. Employment professional technical services grew by 34,000 in March and 311,000 over the year, the 12-month period. Computer systems design related services added 12,000 jobs. Employment continues to trend up in architecture and engineering services, 6,000 there. Management and technical consulting, another 6,000. In March, just a second here. It never goes where we want it to go. Employment in construction showed little change at 16,000, but increased by 246,000. That's in 12 months. Manufacturing changed little for the second month in a row, a negative 6,000 there in March, following 1,000 in a plus 1,000 in February. They added manufacturers added an average of 22,000. Employment in other major industries, including mining, wholesale trade, retail trade, transportation, and finance and government, showed little change over the month. The average work week increased by 1/10 or 1 cent an hour to 3 34.5 hours in March, offsetting a decline of 1/10. In February, manufacturing average work week was unchanged at 40.7 tenths there. While overtime decreased again by 1/10 to 3.4 hours, and not as much overtime there. On non-private payroll rose by 1/10 in March. The average hourly earnings for all workers rose by 4 cents to $27.70, following a 10-cent gain in February. 4 pennies, in other words, this month. Over the past 12 months, the average hourly earning has increased by 3.2%. The average hourly earning for production and non-supervisory workers increased by 6 cents to $23.24. Now you can understand our fight for 15. A number of retailers, etc., are raising their minimum. Target Corporation is are they going to $13 an hour in June, I believe. I don't want to get this wrong on Target, but they are boosting. I think they're at 11 now, so they're either going to 12 or 13 an hour. And Walmart still needs to do a raise. Costco has already done a raise. They're going to 15. They are at $15 an hour now. The non-farm payroll employment for January was revised up from 311,000 to 312,000. There, the changes for February was revised at 20 to 33,000, with the previous revision gains in February and January and February combined for 14,000 jobs there. You can expect this to happen. The next report will be on May the 3rd, so you can look forward to seeing it. And we go here. I won't spend a lot of time on this because you can look at it, but the categories here from March of 2018 and January of 2019, and the change of 2019 in March, and the change from February to March. Let me just get to the chart here. This is non-institutional employment here. These are numbers in the thousands. 257, not 97, and basically about the same. 2058, 39 and 2, and the change was 145,000. This is in thousands. The participation rate, it was at 62.9 and 62.3, and the change actually is a negative 0.2% in March of 2019. And employed, again, that's a negative 201 there. And some of the running averages here that you have. I won't get into that. The unemployed types here, a negative in March would be a negative 2.4. It's 6.221. That would have been in that's the change in March. That's what it would have went to. This is the household data, seasonally adjusted numbers in the thousands. We're reporting here. $155 and $156. It was $156.7 as numbers of employed persons. And here's the employment population ratio. It was at 60.4, and the change is what, a negative 1/10, I believe. Yeah, that's what it is. Anyway, not a lot of change there. 16 and older, 3.8. Yeah, basically over 16. For Europeans, we've been we're around with 3.6. That's starting out last year, to 3.4 in March. This is for Europeans. For African Americans, actually a little bit of a drop here, 6.7 in March, and it was 7 in, let me look at my scale here, in February. Oops. I have to get a better pointer. Okay, back to it once again. 6.7, it was 7, and it was 6.8, and 6.8. So actually, for African Americans, the rate has dropped here, negative 0.3%. Part of the re-election strategy, I suppose. And for Asian bases, the same, 3.1. In Latinos at 4.7. The unemployment rate has actually, it went up a little bit. It was 4.3 the prior month, and then 4.9 and 5.1. So all groups are doing better. Okay, let's move back here to our friends at the March of Manufacturing report here, the PMI. These are the people out of Tempe, Arizona, and the Institute for Supply Change was at 53.3%. And what do we have here? Employment activity in the manufacturing sector expanded in March, and the overall economy grew for the 119th consecutive month. This is from their report. The report issued today by Timothy Foray, the chair of the Institute Supply Chain, registered 53.3, an increase of 1.1% from February's rating of 54.2. The new orders index at 57.4, an increase of 1.9% from February reading of 55.5. The production index registered 55.8, a 1 point increase compared to February reading of 54.8. The employment registered index of 57.5%, an increase of 5.2% from February's reading of 52.3. Supply delivery index registered at 54.2, a 0.7% decrease there. The reading was at 54.9. The inventory index registered at 51.8, a decrease of 1.6 from February's reading of 53.4. The price index registered 54.3%, a 4.9% increase from February's reading of 49.4, indicating a return of increased raw material prices after 2 months respite. Comments from the panel reflect the continual expanding of business strength supported by gains in new orders and employment. Demand expansion continues with new order index returning to the high 50s. Customer inventory index improved but remains too low. And the back order index softening to a marginal expansion level. Consumption, that's production, and employment continue to expand and regain its footing with a combined 6 point gain from the previous month, recovering most of February's loss. Inputs expressed as supply deliveries and index and inventories and imports were lower this month, partially due to inventory consumption exceeding input, resulting in a combined 2.3 decline in supply deliveries and inventory index that combined negatively to the PMI. Import expansion declined to near zero levels. Overall input continues to reflect easing of business environment, but to a lesser extent than in February. That's a very important part there. Export orders continue to expand, but at minimal levels. Price revised 2 months of contradictions, reversed 2 months of contradictions by returning to robust mid-50 levels. The manufacturing sector continued to expand, demonstrated by improvements in the PMI 3-month rolling average, which is consistent overall with manufacturing growth projection. That's Mr. Foray there. Of the 18 manufacturing industries, 16 reported growth in March. And in the following order: printing and related support activities, textile mills, food and beverage and tobacco products, petroleum and coal products, computers and electronic products, electronic equipment, appliances and wood products, non-metallic mineral products, transportation equipment, miscellaneous manufacturing, fabricated metal production, primary metal production, and machinery. The 2 industries reporting a contraction were apparel, leather goods, allied products, and paper products. So that is the index. You sort of get where things are going there. To some of the redundancies here, we have SAP, their cloud business head, of course, cut. They are one of the firms making redundancies. He'd been around a long time. And SAP in January. About 4,400 people would leave on a restructuring plan. Its rival, Oracle had also announced layoffs, and some top talent had defected to Google. So a lot of things going on with some of these outfits here. SAP is not the exception to the rule. 5G, is what you see, what you get. In the Korean Republic said they were the first to get the 5G up and going, and then came AT&T and Verizon for their 5G service. AT&T launched their 5G network in 12 cities, and that was back in December. Verizon, for its part, counted that it came first, hours after the Reuters report. Now they have 5G available on Motorola phones in Chicago and Minneapolis. The intensity with which the companies represent dispute each other well. In other words, the battle for supremacy in the industry that expects to spend $275 billion. That's over 7 years. The winner is playing a central role in helping to generate some $12.3 trillion in annual revenue across a broad range of industries. Now that's by 2035. That's our friends from ISH Market. We usually use their PCIs. Now this technology, and it depends on which flavor you get, is 20 times faster than what we have now as 4G. Being the first is important to our industry. That's from AT&T. They've spent $130 billion on the service over the last 5 years, and even talk of 60. Well, 60 is a long ways away. We first got to get 5G, and some of this 5G service is only to hotspots. So again, you have to see which 5G service they have, and now they have a lot of hotspots. So who had the hotspots here? I went over this article before, and somewhere in it talked about the hotspots, the differentiation between its network. This is AT&T, is available only to consumers using mobile hotspot devices and not the 5G phone. Now Verizon, actually, if you get a Motorola phone, we have a Motorola phone, an older one, but anyway, ours wouldn't do that. But if you have a 5G Motorola phone and in the Midwest, Chicago, Minneapolis, you're in business. Otherwise, well, you can kind of forget it there. Let's go to, let me see. This is again from Reuters, the report. I think we've already went over this report here. Just a minute. Dow averages, we'll do that later here. Negotiations, of course, between the U.S. and China are on. The Pan-European SOFIX 600 index, we usually don't do that, it rose, 0.9 tenths, that's STOXX. Anyway, better than expected. Data from Germany, the industrial output rose at 7 tenths in February as a mild winter in Germany. Now, for the 10-year banknote, rose 3 3/32 to yield 2.500%, and the 2.51 later, that's the 10-year benchmark there. And the dollar index rose 0.8%, with the euro down 0.3 to $1.12, basically speaking. So that's some of the information here. We'll get Brent crude later. Brent crude prices rose 1.5% in a strong economic data concerns there, and we'll get to Brent crude. But here it's at $70.34. That's up 94 cents, or 1.35. And West Texas Intermediate at $63.08. And activities in Libya, there we talked about it on the Bostonred part. That's our political part of General Fatah, and he's moving closer and closer to the Libyan capital. Plus, obviously, in Venezuela, with sanctions and blackouts, they are off their situation there. Let me go to Baker Hughes, which is a part now of GE. Anyway, nonetheless, in the U.S., you have 1,025 wells. That is down 19, and it's 22 change from last year. In Canada, 68 change from last week is down 20, and the change from last year is down 43. Internationally, 1,039 change from last month, up 12, and change from last year up 67. That's the latest from Baker Hughes here. And we've already reported on the 2% growth. Now, this is the economy is growing at an amortized 1.95 in Q2, based on stronger than expected report from domestic manufacturing in March. That is from the New York Fed. This was faster than the 1.62 growth calculated by the New York Fed a week ago. And we already went over the supply chain people, supply management people, ISM there. And let's see what else. New York Fed's forecast estimates the GDP will likely grow at 1.4 pace in Q5. That's with its projected of 1.3% there. Latest GDP views for the first quarter is running below other regional bank models. In Atlanta, they have it at 2.1, and we'll have more of this. We get this information from St. Louis, from the bank in Boston and New York, and we look at Atlanta's now. The Atlanta Fed, they're always a little high at 2.1, the growth there, while the St. Louis Fed is at 2.7. That was on Friday. Okay. We've already talked about PDVSA. That is the Venezuelan oil company, and the sanctions there, prolonged outages. Their capacity is at 7,000 barrels per day. There, and where that goes, who knows? But with Libya and with Venezuela and Iran basically being offline or under heavy sanctions, something will have to give. That their exports fell by 40% in February, the immediate aftermath of the sanctions, but remained stable in March, below 1 million barrels per day. They're very lucky to have that. And they are in a joint venture, of course, with China. So they are doing some upgrading in Venezuela. Okay. Now to the political side of the Fed. DJ Trump is sending reinforcements in. Herman Cain, you remember Herman Cain, he ran for president, Mr. 10-20-10 or whatever he was in his flat tax, and another economic character named Stephen Moore, the beginning polarization at the Fed. This is from CNBC. The potential nominations of King and Moore threaten to politicize the central bank, though will likely not have much sway, no doubt about that. And when it comes to nominees, most people that get nominated to the board, regardless of what party's in power, tend to get nominated based on expertise, and they are largely on the fringe of politics. That's from an economist at Barclays, Michael Gappin. Anyway, the two nominees, Moore and Cain, seem to value more their political contribution than economic gravis. Cain and Moore's views, that both of these seem to have changed their pro-hawkish views to fit with the Trump administration. In fact, Herman Cain was actually in favor of the rate hikes there. So in terms of quantitative easing, it should be absolutely be quantitative easing, Trump told reporters. Now, this is strange because the right-wing economists all called for Dr. Yellen to abandon quantitative easing. The Kretlow described Kane and Moore as being capable. Anyway, we'll just leave that where it is. Herman Cain, incidentally, was on the Kansas City Fed, and he was the chair of the Kansas City Fed, so he does have experience. This Moore character, who knows? He's a regular critic of the Fed's unconventional. Wait a minute, let me get back here. Moore has was an economic advisor to Herman Cain's presidential campaign and created Cain's tax plan and called for return to the gold standard. That was in 2012. He was a regular critic of the Fed's unconventional policy of easing, and this is advocated for a reversal of quantitative easing through $45 billion monthly sales of Treasury securities and so forth and so on, and reduce the Fed's security holdings by 75% is what he advocated. Now he's in a contradictory position. Cain, of course, was at Godfather's. He's for that, but he was also at the Kansas City Fed. Chair of both. I didn't know he was in Omaha with Mr. Buffett, both the Omaha branch of the Federal Reserve Bank of Kansas City and the Federal Reserve Bank of Kansas City. Moore has a Master's of Arts in Economics, doesn't mean anything, from George Mason University. He also served as a fellow at the right-wing Cato Institute, and he was associated with the Club for Growth. That tells it all right there. Normally, the members that get on the Fed, either from the business community, such as Jerome Powell or Jay Powell, are academic economists, are business economists. Dr. Greenspan comes to mind under that rating. Well, then we have academic economists such as Dr. Yellen. But that is not necessarily there. We worked incidentally on our PhD and never got it. Anyway, it doesn't really matter. We're not going to the Fed. Let's do the numbers here, we hope. And I guess we'll just go to the BBC and do the numbers. There's enough going on over at the BBC. Let me see there. I think Boeing is cutting their production of this 737 MAX by roughly 20%. Trump's pick gets World Bank top job. Now, this is another character, something based in Washington. He's a controversial pick there. Malpass, Lawless, was a senior economic advisor to Trump. His appointment stirred a lot of debate somewhere that Malpass, a critic of the bank, will seek to reduce its role. The World Bank has had a sort of a reduction in its role. The U.S. holds a 16% share of the voting power and historically chose the bank's leader. That was from a McNamara a long time ago situation there. David Malpass will need to establish his credibility quickly as a new president of the bank. I don't think it means as much as it used to mean to be in at the World Bank as it did one time. World Bank doesn't. Traditionally, the U.S. picks the president. Europeans choose the INF. INF's in Washington, and the Japanese there. So in other words, as Elizabeth Warren would say, it's rigged. All right, let's do the market data here. Enough of this. The FTSE 100 at 0.61%. It was up there. And in Amsterdam, they were at 0.18%. In France, at 0.23%. In the DAC was at 0.18%. And I think we already gave this one. The Eurostas, this is 50, at 0.16%. And in Madrid, they were in the negative at 0.25%. The Hang Seng. Well, first give Bombay. Bombay at 4.6%. The Hang Seng was down at 1.7% in the negative. The Nikkei closed at 0.38%. And back to New York, where are they? The Dow was at 0.15%, the Nasdaq at 5.9%, and in Chicago they were at 4.6%. And we've already talked about currencies and commodities. Brent crude futures at $70.34. The West Texas Intermediate crude at $63.08. Gold on the Forex, gold futures. We got to get gold futures in here somewhere. There are two indexes here. Anyway, we'll get gold at $1,291.60. No change there. And that was basically it. And that is our numbers for the day that we're able to do. I don't know. I think we did the Boyne's thing there, causing economic problems. Incidentally, Rev Nader lost his great niece in that fatal air traffic there and crash in Ethiopia. They are suing the people at Boyne and the FAA and a number of other people. The navigation system, evidently a software problem sticks out there. The plane needs to be redesigned. So now you have 20% redundancies. Expect more redundancies. Also expect lawsuits to loom for quite some time against Boeing. And the general public, Ralph Nader just said boycott the airline. And we'll extend that for Mr. Nader. Nonetheless, for those in business, have a productive next week. For the consumer, keep your eyes on the prize. Numbers man in the Jerry Pippin broadcast booth. Good day.